You can be completely right about a market and still lose money. The economy grows, the stock market rises, your investment thesis works, and yet your returns disappear. Why? Because of currency. When most people think about investing internationally, they focus on companies' economic and corporate growth or stock performance. But when you invest globally, you're not just investing in a market, you're also investing in a currency, and that changes everything. Here's how it works. Let's say you're an American investor. You take US dollars and convert them into another currency to invest overseas. Then you buy stocks. The market moves. You eventually sell. Then you convert your money back into dollars. That means there are actually two investments happening at the same time, the asset and the currency. Turkey provides a good example of this. Let's say you invested in the Turkish stock market during a period where local stocks were rising. On paper, your investment may have looked successful, but over time, the Turkish lira weakened significantly against the US dollar. So even though the stocks gained value locally, once those returns were converted back into dollars, the gains were reduced dramatically. In some cases, they disappeared entirely. Let's look at this example that was taken from a previous video on this channel. Say you invested $1,000 into the Turkish stock market at an exchange rate of 5 lira to the dollar for a total of 5,000 lira. The Turkish market rises 100%, resulting in a new value of 10,000 lira invested. Meanwhile, the lira depreciates from 5 to 1 to 20 to 1, resulting in a currency loss of 75%. If you sell your investment and convert the proceeds back to dollars, you will receive $500. Overall, you would have lost 50% of your investment. The market made money, but the currency took it away. Why do currencies weaken? Currencies weaken for different reasons. Sometimes it's inflation, political instability, excessive money printing, weak government finances, or trade imbalances. Currencies reflect confidence in the broader economic system. And when that confidence weakens, the currency often follows. This is something you see repeatedly in emerging and frontier markets. In many emerging and frontier markets, currency risk isn't a side issue. It's one of the central risks investors face. And this creates an important distinction. A country can have economic growth, rising industries, and a strong stock market, all while still producing weak returns for foreign investors. A strong economy does not automatically mean strong investment performance. So what should investors pay attention to? 1. Inflation trends. 2. Central bank credibility. 3. Government debt levels. 4. Foreign currency reserves. 5. Trade balances. And 6. Monetary stability, because these factors influence whether a currency remains stable over time. This is why evaluating global markets requires a broader perspective. You're not just analyzing companies or GDP growth. You're analyzing the system behind the market. When investing internationally, being right about the market is only part of the equation. You also have to be right about the currency, the system, and the long-term stability behind both. Because in global investing, you can be completely right and still lose money. If you're interested in deeper analysis on frontier and emerging markets most investors overlook, consider subscribing. This is Frontier Market Intelligence.